Imagine for a moment a financial agreement, maybe an investment you hold, tied directly to something as, well, fundamental as population growth. People being born, dying, moving.
It's a really out there concept when you first hear it.
Exactly. And then imagine that same mechanism potentially being used to provide a regular income, maybe even a guaranteed one. It's definitely a novel way to think about finance and income. So today, on the deep dive, we're going to unpack the details of these structured, real-world, pegged financial contracts. They come from an entity called the Guided Market LLC.
Yeah, and what's really fascinating, I think, is how these contracts seem to connect to a much bigger picture, something called the Common Income Alliance, or CIA.
Right, and let's be clear, that's Common Income Alliance.
Definitely not the other CIA, no. This one apparently aims to set up a guaranteed minimum income for people who register, a very ambitious goal.
So our mission today is pretty straightforward. We want to walk you through how these contracts work, how they're designed, what exactly they're pegged to, and how they might fit into this Common Income Alliance idea. And just so you know, all of this comes from one single, pretty detailed source document we've been given. Okay, let's get into it. So at its core, what are we actually looking at here? To really grasp how this whole system might function, we need to break down the instrument itself.
Right. The document calls them agreements to purchase structured real-world pegged financial contracts.
And the peg, the real-world thing it's tied to, is the percentage change in USA population growth.
Yeah, specifically U.S. population.
And the document highlights a few key things. They work on a monthly interval. They come with what are called non-exclusive redemption rights. We should probably touch on that.
Mm-hmm.
And they have a specific end date, a maturity date, April 15th, 2027.
Right. And source document goes into quite a bit of detail in an offer details section. Some of it's pretty standard stuff you'd see with investments.
Like what?
Well, you've got the initial offer date, the maturity date we just mentioned, an initial price, a current price, basic terms.
Okay.
But then you get things like the initial data value and current data value. And these are interesting because they directly point to the population numbers. That's the core of the peg.
So the actual population figure at the start and what it is now.
Exactly. It also mentions things like minimum and maximum purchase amounts, how much you have to buy or can buy, and increments, practical stuff. And it even specifies a floor and a ceiling for the value of the whole instrument pool, which is interesting. It kind of puts boundaries on the potential risk and return.
Limits. Okay. And you mentioned redemption rights, non-exclusive. What does that mean here?
Yeah, that's a key point. Non-exclusive means the owner, so if you bought one, isn't necessarily forced to only go back to the guided market or its affiliates to exchange it.
So you could potentially sell it to someone else.
In theory, yes. It suggests there could be a secondary market. Now, how easy that would be in reality, the document doesn't really say, but the right is there. It implies more liquidity, potentially.
Okay, that non-exclusive right is definitely something to keep in mind. It hints at a possible market beyond the issuer. But the really big question for me is, how? How exactly does the price of this thing track something like U.S. population growth? It seems so.
Macro.
It's all in the pegging mechanism, and the document lays it out quite clearly. The regulator, the thing that dictates the value, is literally called the United States of America population count.
Okay, very specific.
Very. And the source for this data is the Federal Reserve Bank St. Louis Fed, which is a very common source for economic data. They even give the exact web link to the data series.
Wow, okay. So anyone can go look up the number that's driving this contract.
Precisely. Transparency seems key there. And then there's the function the math used to calculate the price change.
Right.
It's given as 1+% change in data form or price. So wait, let's break that down. If the population grows, say, 1%, and the contract was worth $100 before,
then the new price would be calculated as 1 plus 0.01 times $100, so $101.
Okay, so it's a direct linear relationship, no complex multipliers or anything fancy.
Seems not. Based on this formula, it's a straightforward link. Your investment value moves directly in line with that population percentage change. It's simple, which is good for transparency, I suppose.
But it also means your entire bet is on that one demographic trend, which usually moves pretty slowly.
That's the flip side, yes. It's pegged entirely to that single macro number.
Okay, that makes sense. A very direct link.
Yeah.
So we've got the mechanics of the contract itself, how it's valued.
Yeah.
Now let's connect the dots. How does this specific instrument fit into the bigger picture of this Common Income Alliance, the CIA?
Right, the CIA. The document presents it as, well, a pretty innovative business model. The core aim is, frankly, huge. establishing a guaranteed minimum income for everyone registered.
A guaranteed minimum income.
That's
Ambitious.
extremely. And these structured financial contracts we've been talking about, they seem to be the engine for it.
How so?
They're designed to facilitate transactions between who the document calls customers, presumably the income recipients and clients, maybe those funding or using the system in another way. It acts as the asset underlying the whole income program.
Okay, so let's focus on the individual, the customer. What's it like for them? They just get this security deposited regularly, like income.
That seems to be the idea, yes, a regular deposit of this security.
And what's the benefit? Do they just hold this population-pegged asset?
Well, here's the key. They have the option, it says not an obligation, to exchange their holdings. They can swap them for currency with the company or other approved parties.
Ah, okay. So that's how it becomes usable income. They can cash it out.
Exactly. It provides that income supplement because they can potentially keep the initial value deposited plus any capital gains if the population, and thus the contract value, has gone up. Then they exchange that for cash.
So they get the asset, hold it, maybe it appreciates, then they can choose to sell it.
That appears to be the model described. And the source details some specific parameters for this CIA program, too.
That's yes.
Things like which instruments are eligible for this income program, how often they get deposited, the frequency, the specific quantity and value that goes to a single customer each time,
Okay.
and also the total quantity and value distributed across everyone in the program. And then there's something called the Common Income Alliance Multiplier.
Multiplier, what does that signify?
It's described as the total liquidity to instrument deposit ratio, which, I mean, sounds quite technical, but it seems absolutely critical.
Why critical?
Because it sounds like it measures how much actual cash or liquid assets the system has compared to the value of the instruments it's depositing. If that ratio, that multiplier, isn't healthy,
Then the promise of being able to exchange the instrument for cash might be shaky.
that would be the concern, yes. It really points towards the challenge of liquidity and solvency for the whole guaranteed income scheme. The document highlighting it suggests it's a key metric for whether this whole thing is actually viable.
Right. That makes sense. It all sounds incredibly innovative, maybe even revolutionary if it works. But
There's always a but in finance.
exactly. Risks. We absolutely have to talk about the risks. The document has disclaimers, right? Let's get into the fine print.
Absolutely crucial. And the document leads with a very, very important one regarding registration.
Yes.
It states very clearly, this instrument and any securities issuable pursuant hereto have not been registered under the United States of America Securities Act of 1933 or under the securities laws of any other jurisdiction.
Okay. Not registered under the main U.S. securities law. What does that mean practically for someone thinking about this?
Well, it generally means less regulatory oversight compared to publicly registered securities. The document follows up saying they may not be offered, sold, or otherwise transferred, except as permitted in the Certificate of Deposit and Trust, CODT, and under applicable securities laws pursuant to an effective registration statement or an exemption therefrom.
So trading them might be restricted, or only possible under specific exemptions.
That's often the implication. It can mean higher risk for the investor and potentially much lower liquidity. It might be hard to sell if you need to outside of whatever mechanism the company itself provides.
That's a big flag to be aware of. What other risks does it mention?
It lists several specific ones. First, standard market risk. The value can go up or down based on market conditions. You could lose money.
Okay.
Then credit risk. That's the risk that the issuer, so the Guided Market LLC here, might default on its obligations. Can they actually pay out when required?
Right. Issuer defaulting.
Then liquidity risk, which we touched on. It explicitly says some certificates might be hard to exit quickly without taking a significant price cut.
So confirming that potential difficulty in selling.
Yes. And finally, regulatory risk. Changes in laws or regulations could impact how these certificates perform or if they can even operate.
Okay, so market, credit, liquidity, regulatory risks, all pretty standard categories, but maybe amplified here given the novelty and the non-registered status.
That would be a reasonable assumption. And the source document is very direct about this. It says quite clearly, consult an advisor to fully understand the risks involved.
Puts the responsibility squarely on the potential purchaser.
It does. And it adds that by reading the contract, you're acknowledging you've read, understood, and accepted these risks.
No ambiguity there.
None.
Yeah.
And it finishes the disclaimer section with some important standard warnings, too. This statement is not exhaustive, meaning there could be other risks not listed. Also, all certificates of deposit and trust, CODT, carry risk, and the classic past performance is not indicative of the future, especially relevant for something this new.
Absolutely. Okay, so we've covered a lot of ground today. It's been quite a journey.
It really has.
From this, well, unique financial instrument idea, tying value directly to U.S. population numbers all the way through to how it might be used in this really ambitious common income alliance concept for guaranteed income.
Yeah, and I think what this deep dive really highlights is just how crucial it is to, really dissect these kinds of innovative financial ideas. You have to understand the mechanics, how it's supposed to work. But just as importantly, you need to understand the risks, the ones that are clearly laid out, like in this document, and maybe even think about ones that aren't. It's that constant balance.
Definitely. Innovation versus due diligence. So here's a final thought to leave you with. Considering these contracts are tied to something so fundamental, population growth, and they're potentially being eyed to support a guaranteed minimum income, what are the bigger societal implications if something like this took off?
That's a huge question.
It is. And how would you, listening now, weigh that kind of innovative potential against the very real significant risks we've discussed, especially that non-registered status?
Yeah.
Something to definitely chew on.